Financial regulations. Sounds pretty dry, right? Maybe not the topic you'd immediately click play on.
Definitely doesn't scream excitement sometimes.
But what if those regulations are being written for and maybe even by the wild world of crypto? And what if that whole discussion connects to a massive global problem, getting basic financial services to billions of people? Okay, let's dive in.
It's a really fascinating intersection, isn't it? Policy isn't just abstract here. It's like directly shaping innovation and trying to bring some clarity.
Which has been missing, let's be honest.
Exactly. And you can see how that regulatory push ties into these technologies, trying to solve huge real-world problems.
Totally. So today we're doing a deep dive into crypto policy here in the U.S., looking ahead, what might be coming down the pike in 2025.
And then connecting that to the global picture.
Right, this huge issue of financial inclusion. I mean, 1.7 billion adults still don't even have a bank account.
It's staggering when you think about it.
And then we'll zoom in on one specific player in this space, the Stellar Network, and its crypto, XLM.
Yeah, we've got a good mix of sources to draw from. There's an outlook on 2025 regulation from Fidelity Investments, an article looking at blockchain's potential for financial inclusion globally.
Okay.
Excerpts from Stellar itself press releases, case studies, a market perspective comparing Stellar and Ripple from Changelly.
Interesting comparison.
Community opinions from a Reddit thread discussing Stellar's future, and even some price predictions for what they're worth from a OneSafe blog.
So quite a range. Our mission then is to sort of unpack all this for you. We want to understand the potential regulatory changes, see how blockchain tech could maybe tackle financial exclusion worldwide, and then look closely at Stellar. What is it? How's it actually being used now? And what are the different takes on its future? Basically, get you a clear picture of what's happening and, why it matters.
So, starting with the U.S. regulatory scene, what's kind of interesting is that the crypto industry itself often seems to be asking for more rules, not less.
Right. It feels totally backward. Why is that?
Well, the sources suggest it's the lack of clarity. It's just created so much uncertainty. It's tough for businesses to operate, to build, innovate confidently here if they don't know how the rules apply or what might happen next.
So clarity equals confidence, essentially.
That seems to be the thinking for many, yeah.
Yeah.
They see it as necessary for real mainstream adoption in the U.S.
And 2024 did bring some positive signs on that front, didn't it?
It did seem that way. Seeing the SEC approve those spot Bitcoin and Ether ETPs.
Big deal.
Yeah, and closing that investigation into whether Ether is a security, those felt like maybe steps towards a bit more certainty.
Okay, so building on that, what does the Fidelity source point to for 2025? What are the key areas?
It really highlights three main areas where we might see some movement, legislatively or through executive action.
And number one seems to be all about stablecoins.
Correct. Getting clarity around stablecoins looks like an immediate priority, especially flagged by the Trump administration in the source material. These are the digital coins aiming for stable value, usually pegged to something like the U.S. dollar.
Right. And there are actual bills trying to do this.
Yeah, two prominent ones mentioned are the Genius Act in the Senate and the Stable Act in the House, described as companion bills introduced earlier in the year.
What kind of rules are they talking about putting in place?
Well, the core idea is mandating 1.1 reserves. So issuers have to hold reserves fully backed by qualifying assets, think U.S. Treasuries.
Okay, actual safe stuff backing them.
Exactly. And they'd also explicitly ban algorithmic stablecoins. That's clearly a reaction to that big collapse we saw a couple of years back.
Makes sense. And the Genius Act actually passed a committee vote, and the administration is pushing this too.
Precisely. Genius passed the Senate Banking Committee 18-6, waiting for a full Senate vote. And that January executive order on strengthening American leadership in digital financial technology. It's specifically aimed to encourage stablecoins by clearing up the rules.
How are people reacting to these proposals?
Well, different views, as you'd expect. The sources say supporters hope this clarity will give banks, governments, big institutions the confidence to really jump in, paving the way for mainstream use.
But there are detractors.
Yeah. Critics worry the current proposals maybe don't protect consumers enough, or that they might leave loopholes for big companies to exploit.
Okay, so stablecoins is one big piece. What's the second area?
A broader framework, like a comprehensive set of rules for digital assets overall. The industry seems keen on getting guidelines, so platforms and startups know where they stand in the U.S.
And the main bill for that is FIT 21, Financial Innovation and Technology for the 21st Century Act.
That's the one getting the most attention. Its main goal is to figure out when is a digital asset a commodity under the CFTC and when is it a security under the SEC. That distinction is huge for regulation and enforcement.
It sounds like FIT 21 covers a lot of ground.
It does. Besides the commodity security thing, it talks about decentralization requirements for exchanges, reporting rules, compliance, stablecoin guidelines again, and importantly, it tries to affirm the right for people to hold their own crypto self-custody.
And this bill actually passed the House.
It did in May 2024 with bipartisan support, which was pretty notable. But the expectation is it'll likely get reworked quite a bit before the Senate takes it up.
And the administration is involved here, too.
Yeah, that January executive order also set up a special committee to develop a framework by July 2025. And they have nominated some people seen as, well, crypto-friendly to key positions, maybe even at the SEC.
Okay, so stablecoins, a big framework. What's the third potential regulatory move? This one sounds kind of different.
Yeah, this one was maybe the most controversial. Strategic crypto reserves.
The government holding crypto.
That's the idea. An early March executive order from President Trump established a strategic Bitcoin reserve. The plan was to fund it, initially, with Bitcoin seized from, criminal forfeitures.
Okay.
And it also outlined a U.S. digital asset stockpile for other cryptos besides Bitcoin.
What's the rationale behind the government holding Bitcoin?
The administration's view, according to the sources, is it helps diversify government holdings and lets the U.S. potentially benefit from this emerging asset class, but expanding these reserves beyond seized assets would need Congress to get involved.
Is this just an executive idea, or is there legislation too?
There's a separate proposal, the Bitcoin Act of 2024, mentioned as awaiting Senate review. That one would actually direct the Treasury to buy 1 million Bitcoin over 5 years.
1 million, wow.
Yeah, the goal stated is for the U.S. to own at least 5% of the total supply, which is capped at 21 million Bitcoin.
5%. That's a significant chunk. How is the crypto world reacting to the government potentially becoming a major holder?
Definitely split. Some in crypto see it as a huge validation, a government reserve. That could be a powerful catalyst for mainstream adoption, they think.
But others disagree.
Oh, yeah. A lot of people feel it goes completely against Bitcoin's original idea, being an alternative to government money. They see government ownership as undermining the whole point.
And what about people who are just skeptical of crypto in general?
They oppose the reserves too, but for different reasons. Not ideology, but because they see crypto as just too volatile, too risky for the government to hold as a strategic asset.
So lots of proposals, bills moving around, but how fast is any of this likely to actually happen?
Well, SEC Commissioner Hester Pierce, who's heading up a new crypto task force, apparently said back in February 2025 that defined frameworks are coming, but patience is needed. She emphasized doing it in an orderly, practical, and legally defensible way, which sounds like not tomorrow.
Right. And it's important, as the Fidelity source points out, none of this is set in stone. These are early stages. Things could change, maybe not even pass.
Absolutely. Building an investment plan, just assuming these specific laws will pass. That's pretty speculative.
Okay, so we've got the U.S. regulatory picture, which is complicated and evolving. Now, let's pivot. Let's connect this to that huge global challenge, financial inclusion.
Right, a big shift in focus here.
Yeah.
Financial inclusion basically means everyone, especially vulnerable folks, low-income individuals, having access to useful and affordable financial services. Things like payments, savings, credit, insurance.
And the scale of the problem is just massive. That World Bank number from 2017, 1.7 billion adults globally without even a basic bank account.
That's the unbanked. And then you have the underbanked people with maybe limited access who rely on expensive informal options. The total excluded globally is like 3.5 billion people.
It's almost hard to imagine what daily life is like without those basic tools. No easy saving, no loans for emergencies or starting a business, trouble getting paid or sending money.
And it hits businesses too, especially small ones. The IFC points out over 200 million small and medium businesses in developing countries struggle to get traditional banking services. That really holds back economic growth, since these MSMEs are huge employers, a big chunk of GDP.
In our super digital world, why is this still such a huge problem? What are the barriers?
The sources list several key things. Just physical distance from a bank branch is still a big one in many places.
Right.
Not having enough money for minimum balances, high fees, and a really major one, lack of official ID documents. Estimated 2.4 billion people lack a digital identity.
Wow.
Other reasons include family members already having accounts, cultural or religious objections, or just a basic lack of trust in the financial institutions themselves.
But we have seen some progress with digital tools, haven't we? Like mobile phones.
Definitely. Mobile phones and the internet have made a difference. The sources mention things like Brazil's Bolsa Familia program using digital payments, and of course, M-Pesa in Kenya, which was a game changer for mobile money way back in 2007.
But it feels like progress is still too slow.
It seems that way. Millions have gained access, sure, but it's not keeping pace with the need. And big gaps remain, like between men and women having accounts in many regions. So there's clearly a lot of room for new approaches.
Which brings us to blockchain technology. Is this the potential accelerator for financial inclusion?
That's the argument many are making. At its core, remember, blockchain is this distributed ledger. Instead of one central authority, the record of transactions is shared and verified by consensus across a network.
And that decentralization plus the cryptography is meant to bring transparency and efficiency.
Exactly. And proponents argue this structure is uniquely suited to tackle some of those barriers we just talked about.
Like the high fees. Sending money internationally can cost a fortune.
It really can. Blockchain potentially allows for near real-time payments with much lower transaction costs because you're cutting out intermediaries, clearinghouses, correspondent banks, card networks. And if both the sender and receiver use the same virtual currency, maybe you bypass currency exchange fees altogether.
What about the identity problem? Opening accounts for people without passports or bills.
Blockchain could help there too, especially combined with other tech. It could support decentralized digital identity systems. The source mentioned HumanX app using facial and voice recognition for ID on the blockchain.
Interesting.
And because blockchain records are hard to tamper with and transparent, it could be great for securely storing verified Know Your Customer or KYC info. That can make it much easier and cheaper for institutions to onboard people who lack traditional documents. Plus, low-cost mobile transfers obviously help overcome distance barriers.
And could it help build that trust that's often missing?
That's a key part of the pitch. The Economist famously called blockchain the machine for building trust. The idea is instead of trusting one central entity, you trust the decentralized network's rules and consensus. For some communities, maybe that collaborative model feels more trustworthy than distant banks or governments.
And financially, there's a big opportunity in serving these excluded populations.
Huge. Remittances alone, money sent home across borders, was over $466 billion back in 2017. The article estimated payment companies could unlock like $200 billion in new annual revenue by creating the right products for the financially excluded.
So the potential seems clear, but what are the big hurdles? Why hasn't blockchain already solved this?
Well, the sources point to some significant challenges. Just basic awareness and understanding are still low. Many people just don't get the tech, which limits trust and adoption.
There's a cultural shift needed too, right? Trusting a network instead of a person or institution.
Exactly. That's unsettling for many. Then there's regulation and governance, still unclear globally how these new tools fit existing rules. Regulators are learning too.
And scalability always comes up with blockchain.
Yep. Can it handle massive global volume efficiently? It needs more time, more real-world proof, better integration with the existing financial system. Plus, environmental concerns about energy use for some cryptos, and the fact that there's so many different blockchains. It fragments things.
Okay, this leads us perfectly to Stellar, a specific network that seems purpose-built for this financial inclusion challenge.
Yeah, Stellar is really relevant here because its whole mission from the start was about enabling fast, cheap, global money movement for everyone, specifically designed with the developing world and financial inclusion as core goals.
And it has an interesting connection to Ripple, doesn't it?
It does. Jed McCaleb, who co-founded Ripple, also co-founded Stellar. They share some DNA distributed ledgers, no mining, but their target markets and missions diverged pretty early on.
Right. And just to be clear, Stellar is the network, the technology.
And Lumens, XLM, is the cryptocurrency that runs on it.
Got it. So how does Stellar's mission really differ from Ripple's and connect to financial inclusion?
While Ripple seemed to focus more on banks and big financial institutions, Stellar's always aimed at the developing world, at everyday people, specifically the unbanked. The fact that it's run by the Stellar Development Foundation, the SDF, which is a nonprofit,
Oh, okay.
that really emphasizes the mission-driven aspect. McCaleb himself has talked a lot about helping the unbanked, even saying he donates his lemons toward that cause.
What about the tech itself? What makes Stellar suitable for this?
It uses its own consensus method, the Stellar Consensus Protocol, or SCP. It's designed to be faster and use way less energy than Bitcoin's proof of work.
Okay.
It also supports smart contracts now through a platform called Soroban. And crucially, it lets people and institutions easily create tokens representing real-world things like digital dollars or even other assets. We're seeing news about that, like Draper University having a Soroban accelerator, and companies like WisdomTree using it to tokenize assets.
Tech details are one thing, but seeing it work in the real world is always more convincing. Do the sources give us actual examples?
They do. And these case studies really illustrate how Stellar is being used to tackle those financial inclusion barriers right now. One good example is Get Paid in Africa.
Okay, tell us about Get Paid.
So Get Paid is a platform connecting African digital workers, freelancers, creators, traders with companies around the world that want to hire them.
Right, bridging that gap.
Exactly. But the big challenge was payments.
Yeah.
How do you pay these people easily and cheaply across different African countries, different currencies, different banking systems?
Big problem.
So Get Paid uses the Stellar Anchor Network. Anchors are like bridges between Stellar and traditional finance. They let you move value between crypto and fiat currencies using local partners.
How does that work for, say, a freelancer using Get Paid?
When they sign up, a Stellar wallet gets created for them automatically, kind of behind the scenes. The user interface is kept simple, hiding the blockchain stuff. They can then get paid by international clients through an anchor. The payment comes in, gets converted automatically to USDC, that's a stablecoin pegged to the dollar, and lands in their digital wallet on Stellar.
Okay, so they hold stable dollars digitally.
Right, and from there, they can keep it as USDC, use it maybe for online courses on the platform, or cash it out easily through another anchor into their local mobile money account, bank account, or even a crypto exchange.
That sounds incredibly useful for someone maybe without a bank account, letting them tap into the global gig economy.
It really is. And Get Paid actually got funding and support from the Stellar Community Fund, which helped them build faster. It shows the SDF actively backing projects using the network for these kinds of use cases.
That's a great example. Is there another one?
Yeah, another compelling case is Bigger Global Payroll. This is a software company that needed to pay its workers all over the world. They were struggling with slow, expensive manual processes and also dealing with currency devaluation impacting their employees in places like Argentina.
Oh yeah, currency volatility is a nightmare if you're earning in a local currency that's unstable.
Totally. So Bigger started using the Stellar Disbursement Platform, or SDP. It's an open source tool designed for sending out bulk payments on Stellar.
Okay.
This let them streamline their payroll dramatically. What took days now took minutes using bulk uploads. They could create wallets easily for employees and bypass a lot of those cross-border currency fees.
And for the employees, say in Argentina, how did it help them?
This is where the stablecoin aspect on Stellar is key for inclusion. Employees got paid directly into their Stellar wallet in USDC.
Again, the stablecoin.
Exactly. So the value of their earnings was protected from local currency swings. That gives them stability they wouldn't normally have. They could then choose when to convert that USDC to pesos based on their needs and maybe the exchange rate.
Wow, that control and protection must be huge for them.
It really is. And the source even mentioned Bigger used their setup to help distribute digital aid for a migrant shelter in Mexico City, getting funds to residents quickly. So the benefits are clear. The company saves time and money, reduces errors. The employees get paid fast, hold stable value, and have choices.
These real-world uses are powerful, but like any tech, Stellar faces challenges, and people have very different views on its future, right?
Definitely. Those broader blockchain challenges we talked about, awareness, regulation, getting people comfortable, scaling up, fitting in with the old system, those all apply to Stellar too, as it tries to achieve widespread adoption for financial inclusion.
And looking at community discussions, like that Reddit thread, you see a real split in opinions, especially about XLM as an investment.
Oh, absolutely. On one side, you've got the bulls, the very supportive folks. Some see Stellar as a really long-term play, like 10, 20 years out. They point to the SDF's nonprofit mission and commitment as reasons to be confident.
And they seem excited by the recent tech upgrades.
Yeah, they highlight things like Soroban, the smart contracts platform, launching and performing well. And big names like WisdomTree tokenizing assets on Stellar. They see that as huge validation. They also praise the CEO, Danelle Dixon, for pushing adoption globally, especially in Africa, and for engaging with U.S. policymakers.
I've heard the comparison to the early internet for crypto generally. Does that come up for Stellar?
It does. This idea that we're still super early like the internet in the 90s, and Stellar's underlying usefulness will eventually win out. Supporters stress Stellar's focus on actual use cases today. They say it's already fast, cheap, green, secure.
Functional.
Right, functional now, not just hype. And they believe that as the ecosystem grows, as more people use it, the XLM price will eventually reflect that through market sentiment. They see it fundamentally as a payment system that works.
Okay, but then there's the other side. The critics, the bears, what are their main points?
There's definitely significant criticism. A big one for some investors is that XLM's price hasn't gotten anywhere near its all-time high from way back in 2017. They see that as a bad sign after all this time.
And some criticism targets the SDF directly.
Yes, a common complaint is about the SDF holding vast amounts of XLM, and according to critics, selling it regularly. They argue this suppresses the price and mainly benefits the foundation and early insiders, not average investors.
Are there technical criticisms too? Like, is the tech keeping up?
Some argue it's not. They might say Stellar's transaction speed, its TPS, is falling behind newer, faster chains, sometimes comparing it unfavorably to something like Solana. There are also questions raised sometimes about Jed McCaleb's current level of active involvement.
And the way the coins were created initially, the pre-allocation, that's still a sore spot for some.
Is for critics, yeah.
Yeah.
They see that large initial distribution to the SDF and early parties is fundamentally unfair. You also hear comments pointing out that being nonprofit doesn't mean staff can't earn high salaries, which rubs some people the wrong way given the mission.
So a sense of skepticism about what's actually been delivered over the years.
For some, yes. They might ask, what has Stellar really achieved in 7+ years if it's not reflected in value for investors? There was even frustration noted from non-developers who feel they have good ideas for adoption, but find it hard to engage with the SDF.
So yeah, clearly no consensus there on Stellar's future or value.
Not at all. It really depends on your perspective, mission, and utility versus investment returns and tokenomics. The sources show some investors are hedging, holding both Stellar and Ripple. Others just see XLM as maybe a small part of a long-term portfolio, not a speculative bet.
And those price projections you mentioned earlier from OneSafe, they probably reflect that uncertainty too.
They definitely do. It showed a huge potential range, anything from $0.40 up to $9 between 2026 and 2029. You have to take those with a massive grain of salt, obviously. They're just projections based on technicals and market factors underlining how volatile or uncertain predicting crypto prices really is, especially years out.
Okay, so this deep dive really has woven together some threads that might seem separate at first glance. We started with the pretty complex world of U.S. crypto regulation.
Yeah, seeing how policymakers are trying to get a handle on this fast-moving space.
Then we connected that push for rules to the massive global challenge of financial exclusion, understanding the barriers billions face and how tech like blockchain offers potential solutions.
Right, a path towards maybe greater access and opportunity.
Then we zoomed right in on Stellar, looked at its specific mission targeting the unbanked, and saw concrete examples get paid, bigger, showing the tech actually being used to solve real problems now.
But we also saw the complexities, the challenges blockchain still faces, the very different opinions in the community about Stellar's value and prospects, and just the general uncertainty that's still baked into this whole space.
It seems clear that while the rules are still being written, the potential for tech like Stellar to make a real difference in getting basic financial services to billions, that potential is still huge.
It is. But it exists alongside those real-world hurdles and, very different views on how impactful or valuable it will ultimately be.
What really stands out is that tension, isn't it? Between formal government regulation trying to put structure around this and the decentralized innovation just charging ahead with new ways to move value.
Yeah, that push and pull is fascinating to watch.
So as policymakers grapple with regulating digital assets and the technology keeps evolving to tackle global challenges like financial inclusion, how might this ongoing dynamic, this tension between regulation and innovation, ultimately reshape finance for all of us, individuals and businesses alike? Something to chew on after this deep dive.